The banker goes quiet for a beat, then says, "Let me see what I can do." 5 minutes later, the fee disappears, the hold on your account gets lifted, and the whole problem melts away like it never happened. You hang up and you feel this weird mix of relief and confusion because last year the same bank told you, "Sorry, that's policy," and you ate the fee with a smile you couldn't afford. That switch isn't random. It isn't about you being nicer on the phone or using the right tone or getting lucky with a better rep. It's about a number, and the moment that number crosses certain thresholds, the bank's entire posture changes. Not because they like you more, but because the math flips. My name is Andy. In this video, I'm going to show you 3 net worth levels where banks start treating you differently, what actually changes at each level, and why it happens. And I don't just mean they offer you a nicer credit card. I mean the rules, the fees, the speed of yes, the interest rate you get, and how quickly problems get solved. Here's the promise. By the end, you'll understand the exact mechanism banks use to rank you, why net worth only matters if the bank can see it, and how people who don't look rich end up paying the highest prices in the system. And if you're not at any of these levels yet, you'll still know how to get most of the benefits without faking anything or playing games. Because banks aren't moral judges, they're pricing engines. Every customer gets sorted into one of 2 buckets: a cost to serve or a profit center. If you're a cost, the system tries to squeeze you with fees, friction, and rigid rules. If you're a profit center, the system tries to keep you happy with waivers, speed, and exceptions. So what flips you from cost to profit? It's not your income. Income is a rumor. You can make a lot and still have nothing left at the end of the month. What banks really love is assets they can touch, deposits, investments, loan balances, and predictable cash flow they can measure. That's why 2 people with the same salary can get treated like they live on different planets. And one more thing before we jump in. When I say net worth levels, I'm talking about the levels where your net worth usually becomes visible to a bank because you've built assets somewhere. If your net worth is in a retirement account at a place your bank can't see, your bank won't treat you like you have it. The treatment follows what you bring into their building, not what you have on paper. All right, first level. Around $100,000 of net worth. Not because it's magical, but because it's usually the first time you can keep meaningful cash and investments in one place without sweating every bill. And at that point, banks start offering you something that sounds boring, but changes your daily life. The end of nuisance fees. Think about what most people pay just to exist inside the banking system. A monthly maintenance fee, a wire fee, an overdraft fee, an out-of-network fee, a minimum balance fee. None of those fees exist because they have to. They exist because the bank can. But once you've got a real balance, even if it's only 5 figures sitting in checking and savings, suddenly the bank discovers flexibility. That's the first shift. Once you're hovering near that 100,000 net worth neighborhood, you start getting relationship offers. The bank might say you qualify for premium checking if you keep a certain average balance or direct deposit. Translation, they'll stop charging you the little tolls and they'll hope you park more money with them. Here's a quick math moment that feels small until you stretch it out. A $15 monthly fee is $180 a year. Invest $180 a year for 30 years at 7%, and you're looking at roughly $17,000. That's from one tiny fee you barely notice. Banks love tiny fees because they're quiet, and they hit the people who can least afford the compounding loss. At this first level, the biggest change isn't the perks. It's the way policy starts to bend. You call about an overdraft, and instead of a lecture, you get a reversal. You ask about a hold on a deposit, and it gets expedited. You request a fee waiver, and you hear a phrase you almost never hear when your balance is low: "We can make a one-time exception." And that phrase, "one time," is cute. Because if your balances stay up, it becomes no problem the next time too. But here's the catch, and it's important. You might have $100,000 in net worth, but if it's split across 5 apps in a retirement plan, the bank you call sees a checking account with $900. That's the version of you they serve. So if you want the treated differently switch to flip, the bank has to see the weight. Now let's talk about why the bank cares at this level. Because it's not charity. Banks run on cheap money. Your deposits are cheap money. If you keep $10,000 in a savings account earning almost nothing, the bank can lend against that money at a much higher rate. That spread is their oxygen. When you've got more cash and you're stable, you become a better source of oxygen. This is also why credit starts to feel different. Not just your score, but your limits. A bank would rather lend to someone who has assets sitting right there than someone who's one emergency away from missing a payment. So you'll notice credit card limits rising, approvals getting smoother, and even the tone of the offers changing. Less, please open a starter card. More, you've been selected. Have you ever wondered why a bank will loan someone hundreds of thousands for a house but won't spot them a few hundred without punishing fees? That's the system telling you something. The system doesn't reward need. It rewards safety and profit. At the 100,000 level, you also start getting introduced to a person. Not real service, not yet, but a named banker, a direct line, a calendar link. It feels like attention. It's really segmentation. The bank's trying to pull you up the ladder before you wander to a competitor, so that's a level 1. Your life gets less noisy, fewer fees, more flexibility, more yes. But the second level is where the treatment changes from "we'll stop punishing you" to "we'll start courting you." Level 2 is around $1 million of net worth. And again, the number isn't sacred. It's just where a lot of banks draw a line between mass affluent and high net worth. It's where you stop being a retail customer and start being a relationship. Here's what that looks like in real life. You get a dedicated relationship manager. Not a teller, not a rotating call center rep, a person whose job is to keep your assets at the bank. You get faster responses, access to better loan pricing, and the ability to negotiate things that used to be fixed. And the reason is simple. At $1 million in assets, you're not just a person with a checking account. You're a walking revenue stream. Even if the bank charges a modest fee on investments, even if they earn a small spread on your cash, even if they cross-sell one loan, the lifetime value of you as a client gets big enough to justify human attention. Let's do a second math moment, because this one can get expensive fast. Imagine two people buying the same home, same price, same down payment. One gets a mortgage rate that's 0.5% lower because the bank wants their relationship and offers preferred pricing. 0.5% sounds like nothing when you say it fast. On an $800,000 mortgage over 30 years, 0.5% can mean roughly a few $100s a month in payment difference, and well over $100,000 in total interest over the life of the loan. Even if you sell or refinance earlier, that lower rate still saves real money during the years you're paying it. This is why wealthy borrowers obsess over basis points. Tiny numbers, huge outcomes. And here's the part most people miss. It's not always about risk. Sometimes the wealthier client is actually riskier in behavior. Bigger loans, bigger leverage, bigger ambitions. But the bank can secure the relationship. They can collateralize, they can structure, they can protect themselves. That's why treatment improves. At this 1 million level, you also start seeing something that feels like a secret menu. Securities-backed lines of credit, relationship discounts, asset-based lending. The bank starts saying, instead of selling your investments, you can borrow against them. And that can be useful, but it's also where the traps get sharper. So let's bring in a psychology moment, authority bias. When a person with a title and a calm voice tells you, this is what high net worth clients do, your brain wants to comply. It feels like an insider move. It feels sophisticated. That feeling is dangerous because the bank's incentives didn't vanish. They just got dressed up. The products get more complex. The fees get harder to spot and the sales pitch gets smoother. At the retail level, they ding you with a $35 overdraft fee. At the high net worth level, they might quietly steer you into a 1% advisory fee that drains tens of thousands a year. That's not me being cynical. That's the business model. Banks don't become nicer. They become more strategic. Here's the third math moment, and this one is brutal because it hides inside normal. A 1% management fee on $1 million is $10,000 per year. If that portfolio grows, the fee grows too. If you're paying 1% on $2 million, that's $20,000 a year. Over a decade, that can be hundreds of thousands, and that's before you even consider the compounding you lost because the fee money didn't stay invested. So when the bank starts treating you better at $1 million, part of the deal is they're also trying to find a bigger, cleaner way to get paid. Your job is to separate service from sales. Now, quick question. Why would a bank waive your wire fees and rush your paperwork, then turn around and pitch you a product that costs $10,000 a year? Because waiving wire fees costs them almost nothing. Locking your assets into their fee machine is worth a lot. At this level, you also get another perk that sounds boring but matters: credit capacity. Not just approved, but approved fast. If you want a credit line for a business, or a bridge loan, or a home equity line, the conversation changes. The bank starts asking, "What do you need?" instead of "Prove you deserve it." And if you've never felt that shift, it can mess with your head. It can make you think the bank respects you now. What's really happening is the bank respects your balance sheet. All right, level 3. This is the level where banks stop reacting to you and start competing for you. Level 3 is around $10 million of net worth. Sometimes it's higher, sometimes it's lower, but in that neighborhood, you cross into true private banking territory. And private banking isn't a nicer checking account. It's a different relationship with the financial system. At this level, the bank assumes you have options, not just other banks, but other ways to borrow, other ways to invest, other ways to custody assets. So the bank's job becomes retention through convenience, customization, and pricing. This is where you see the biggest difference in lending. People hear wealthy people borrow, and they assume it's some flex. The reality is more practical. If you've got a diversified portfolio, the bank will often let you borrow against it at relatively low spreads because the collateral is liquid and measurable. That means you can access cash without selling assets and triggering taxes. You can move quickly when an opportunity appears. But here's the thing: leverage is a tool, not a personality trait. It can help you buy time, or it can help you blow up your life faster. Banks will happily offer it either way because the loan is profitable and the collateral protects them. At 10 million, you'll also notice service becomes proactive. Calls get returned fast. Exceptions become routine. Paperwork gets handled by someone else. If a fraud alert hits your card, it gets resolved like an inconvenience, not like a trial where you have to prove you're innocent. And yes, there are perks that sound almost silly: concierge services, travel help, access to events. That stuff is marketing. It's the dessert tray. The real meal is pricing and access. Because at this level, banks might offer better spreads on loans, negotiate advisory fees, reduce trading costs, provide customized credit structures tied to your actual balance sheet instead of a generic underwriting box. You stop fitting into products. Products get fitted to you. Now, system critique time, because this is the part that should make you a little angry. Banks will tell you they treat everyone fairly, and in a narrow legal sense, sure, they follow rules. But economically, the system is designed to subsidize the wealthy with the fees paid by everyone else. If you've got low balances, you're the person paying maintenance fees, overdraft fees, cashier's check fees, out-of-network fees, and punitive interest on small credit lines. If you've got high balances, you get those fees waived, you get higher service levels, and you get better pricing on borrowing. So the people with less pay more for the same infrastructure, while the people with more pay less or even get paid through better rates and perks. That's not an accident. That's segmentation. And there's a psychological layer that makes it stick. When you're lower net worth, you feel like fees are your fault. You feel like you messed up, so you accept them quietly. When you're higher net worth, you feel like fees are negotiable. You expect exceptions. That expectation alone changes outcomes. So what can you do with this information if you're not sitting on 1 million or 10 million? First, understand the dirty secret I hinted at earlier. Banks don't actually see your net worth. They see your relationship value. That means you can sometimes get treated like the next tier up simply by consolidating what you already have, so the bank sees it clearly. If you've got $10,000 in cash, a steady direct deposit, and a clean history, you can often get premium checking perks even if your net worth isn't huge. If you've got investments spread across places, consolidating might unlock better pricing or better service. Not because the bank suddenly loves you, but because the metrics flipped on their dashboard. Second, ask for reversals and waivers like you expect them, because expectation changes conversations. If a fee hits and you've been a good customer, call and say, "Can you waive that?" Not apologizing, not begging, just asking. The worst they can say is no, and you'll be shocked how often you hear yes. Third, shop the relationship like it's a job offer. Banks compete, especially for customers who look stable. If your bank treats you like a problem, another bank might treat you like an opportunity. Even a credit union or a smaller regional bank might offer better service and fewer fees because their model relies less on squeezing the bottom. Fourth, Watch out for the upgrade trap. When banks start treating you better, they'll also start offering you more complexity, more products, more leverage, more exclusive options. The pitch will feel like a reward. Your job is to translate every offer into plain language. What's the fee? What's the rate? What's the downside? What happens in a bad year? If a product can't be explained simply, it's not automatically bad, but it's automatically suspect until proven otherwise. Now let's land this with a clean recap, because I want this to stick in your head the next time you walk into a branch or call customer service. Around $100,000 of net worth, banks start removing the nuisance pain. Fees get waived, flexibility appears, and policy stops feeling like a brick wall. Around $1 million, you start getting courted. You get a person, you get negotiation power, and you start seeing preferential pricing, especially on loans. But the sales machine also gets more subtle, so you've got to stay sharp. Around $10 million, you enter private banking. The relationship flips. Banks compete for you, service becomes proactive, and credit gets structured around your balance sheet. The upside is convenience and pricing. The danger is leverage and opaque fees that scale with your wealth. And if you take nothing else from this, take this. Banks treat you differently because you represent a different profit equation. So if you want better treatment, your best move isn't to act rich. It's to understand the equation, reduce the ways you get charged for being small, and build assets in a way that makes your options expand over time. The endgame isn't getting a nicer banker. The endgame is having enough leverage that you never feel trapped by one institution's rules. Before we wrap, I want to give you the cheat code that isn't really a cheat code. It's just understanding what the bank's scoreboard looks like and then making sure you're not getting graded on the wrong stuff. Banks care about relationship value, not your potential. So if you've got 3 accounts at 3 different places, each with a small balance, every institution sees you as a low-value customer. But if you consolidate and keep a higher average balance in one place, you can trigger the exact same internal tiering that richer customers get. Here's a simple example. Say you keep $5,000 as a buffer and you're disciplined about never touching it. If you spread that across 3 banks, none of them sees enough to waive anything. If you park it at one bank, you might unlock a premium checking tier that wipes out monthly fees and gives you fee-free ATM access. Same money, different treatment. And the difference compounds in a way people ignore. 3 overdraft fees in a year at $35 each is $105. Add a couple out of network ATM fees, let's say 4 times at $5 each, that's another $20. You're at $125 and you didn't buy anything. You just paid for being small in the system. Now flip it. If you keep a steady direct deposit and a stable average balance, a lot of banks will reverse those fees even if you slip once. That's not because you became more responsible overnight. It's because the bank expects you to stay, and it wants to keep you calm. This is where psychology messes with people. Loss aversion makes a $35 fee feel like a personal failure, so you avoid calling. But the bank designed that friction on purpose. They're counting on you feeling embarrassed enough to eat it quietly. So call anyway. Say, "I'd like that waived." If they say no, ask, "What balance or account type waives it?" Make them tell you the rule, because once you know the rule, you can decide if it's worth playing. Another move that works way earlier than people think is using competition. You can say, "I'm considering moving my direct deposit and savings. What can you do for me?" Banks hate losing sticky money like payroll. You'll be surprised how quickly policy turns into options. And one more warning, because this is where people get tricked as they climb. The nicer the service, the easier it is to confuse friendliness with alignment. A banker can be genuinely kind and still be graded on how many products you adopt. So every time you hear exclusive translated into, "How does the bank get paid?" Ask for the fee in dollars per year. Ask for the interest rate in plain language. Ask what happens in a bad year. If the answers get slippery, that's your answer. So yeah, banks treat you differently at different net worth levels, but the deeper truth is, they treat you differently when your money becomes easier to earn from. Your goal isn't to impress them. Your goal is to stop paying the expensive version of basic banking and start buying financial products like you've got choices. If you want more videos that break down these invisible rules and show you the plain math behind them, subscribe. And next time you get hit with a fee or a slow no, you'll know exactly what the bank's really reacting to and how to make the conversation change.